The Australian government is legally required to give eligible workers free money for their superannuation, not a rebate, not a tax offset you claim later. Actual money contributed directly into your super account, and the majority of Australians who qualify for it never receive a single dollar of it. That's not an opinion. That's the consistent finding from the ATO's own data on the government co-contribution scheme, year after year. Hundreds of thousands of eligible Australians leaving government money uncollected, simply because they didn't know the rules. That's hack number 2. And by the end of this video, you'll understand all 3, including why salary sacrifice is more powerful than most people think, why the catch-up concessional contribution is one of the most underused tools in the entire super system, and what to do with each strategy this financial year to make a meaningful difference to your retirement balance. Let's go. Here's the scenario most people find themselves in. You've been contributing to super for years. Your employer puts in the compulsory percentage each pay cycle. You receive your super statement once a year, glance at the balance, and move on. The system feels like it's running. You feel like you're doing what you're supposed to do. But there's a version of this where you're doing the same thing, the same job, the same income, the same super fund, and your balance is growing significantly faster. Not because you're earning more, not because the market is performing better, simply because you understood 3 specific strategies that the system makes available to you, and you use them. Most people never use them, not because they're complicated, because nobody clearly explained them. Let's start with salary sacrifice, because this is the one most people have heard of but least understand the real power of. Salary sacrifice means you agree with your employer to redirect a portion of your pre-tax salary directly into your super fund, rather than having it paid to you as take-home pay. The amount that goes into super is taxed at the super fund's rate, which is generally 15% per grade, for most people, rather than at your marginal income tax rate. For someone on a marginal tax rate that's meaningfully above 15%, this difference is real money. Every dollar that goes through salary sacrifice, rather than ordinary salary, saves the gap between your marginal rate and 15% on that specific dollar. Across a full year of contributions, that saving compounds. But here's the part most people miss about salary sacrifice. It doesn't feel like saving, because your take-home pay reduces. So people often don't start it, or they try it briefly and stop because it feels like a pay cut. And that instinct, that very human reaction, is exactly why so many people leave this strategy untouched for years. Here's a different way to think about it. If you were offered a pay rise tomorrow that went entirely into your super fund, would you take it? Most people would say yes, because it's still growing your wealth, just in a different container. Salary sacrifice is the reverse of that. You choosing to redirect existing income into a container where it grows more tax efficiently. The practical mechanics are straightforward. You speak to your employer's payroll department. You complete a salary sacrifice agreement. The arrangement can typically be set up and started within one pay cycle. There's no complex application with the ATO. It's an arrangement between you and your employer. The key constraint to be aware of is the concessional contributions cap, the annual limit on how much can go into your super at the lower tax rate, including both your employer's compulsory contributions and any salary sacrifice amounts. If you approach your accountant or financial advisor about salary sacrifice, they can calculate exactly how much space you have within the cap for your specific situation. And if you're thinking about starting this strategy, the best time to start is always now, not at the next performance review or after the new financial year begins. Every fortnight you delay is a fortnight where money that could have been growing in super at a lower tax rate was paid as ordinary income instead. But here's what surprises people even more than salary sacrifice: the government co-contribution. And this one genuinely shocks people when they understand it, because it's free money that the government sends directly to your super, and most eligible people never claim it. Here's how it works. If you are a low or middle income earner, and the specific income threshold changes, so always check the current ATO eligibility criteria, and you make a personal after-tax contribution to your super fund. The government matches a portion of that contribution with a co-contribution of their own, paid directly into your super fund. You don't apply for it. You don't lodge a separate form. You lodge your tax return. And if you meet the eligibility criteria, income below the relevant threshold, personal, after-tax super contribution made during the year, the co-contribution is automatically calculated and paid into your fund by the ATO. The maximum co-contribution amount and the income range over which it applies changes with indexation.
So the specific figures you need to check are always the current year ATO figures, but the principle is consistent. For eligible Australians, making a personal super contribution in the right financial year generates a government bonus on top of what you put in. What makes this strategy particularly powerful is the return it generates. If the government matches a portion of every after-tax dollar you contribute, the immediate return on that contribution is dramatically higher than any savings account, term deposit, or managed fund is likely to deliver. You are effectively receiving a guaranteed positive return the moment you make the contribution, before any investment return is added. The people most likely to miss this are self-employed workers, part-time workers, people on lower incomes, and workers who receive irregular pay. These are often the people who feel they can't afford to make extra super contributions, but the co-contribution specifically rewards small contributions. You don't need to contribute the maximum to benefit. Even a smaller contribution that attracts even a smaller co-contribution is still free money that would not otherwise exist in your super fund. Check your eligibility. Check the current ATO figures for the financial year. And if you qualify, make a personal after-tax contribution before the 30th of June. It really is that simple. The next part is where most people get caught, because it involves a rule they've never heard of, and it could be worth more to their super balance in a single year than they've contributed in the previous 3. Catch-up concessional contributions. Here's the background. The concessional contributions cap, the annual limit on how much can go into super at the DOM, 15% tax rate, is set by the government. For most people, this cap is not fully used in any given year. Employer contributions cover part of the cap. If you salary sacrifice, that covers more. But unless you've been maximizing your contributions every year, some of that cap is left unused. Under the carry-forward rules, unused concessional cap space from up to 5 previous financial years can be carried forward and used in the current year. This means that if you have years of unused cap space because you were working part-time, raising children, on a career break, or simply didn't know the strategy existed, you may be able to make a single large concessional contribution this year that uses all of that accumulated the forks at once. The tax benefit of this is significant. A large concessional contribution reduces your assessable income for tax purposes by the amount of the contribution, up to your available cap. If you're in a year where your income is higher than usual, perhaps because of a bonus, a property sale, or a redundancy payment, making a large catch-up concessional contribution in the same year can dramatically reduce your overall tax bill for that year, while simultaneously boosting your super balance. But here's the critical condition most people don't know. To use the carry-forward concessional contribution, your total super balance at the end of the previous financial year must be below a specific threshold set by the legislation. This threshold changes with indexation, so always check the current figure with the ATO or your accountant. If your balance is above the threshold, you cannot access the carry-forward rules. This condition means that for some Australians, particularly those with larger balances, the strategy is not available. But for the many Australians who have had interrupted careers, worked part-time, or simply haven't been maximizing contributions, both the condition and the opportunity are likely in their favor. How do you know how much carry-forward space you have? Log into your MyGov account. Go to the ATO section. Your available carry-forward concessional cap space is displayed there, broken down by financial year. It's not a number you need to calculate yourself. The ATO maintains it for you. Let's put all 3 strategies into one person's story. Consider a woman. We'll call her Sandra. She's 54. She works part-time as an administration manager, earning a moderate income. She owns her home with her husband, who also works. For the past 6 years, she contributed only what her employer required. No salary sacrifice, no personal contributions. Her super balance is meaningful, but below the maximum threshold for carry forward. Eligibility. Sandra has never heard of the government co-contribution. She assumed it was only for people on very low incomes, and that she wouldn't qualify. She has never asked her employer about salary sacrifice, because she assumed the paperwork would be complicated. This financial year, Sandra checks her ATO account on MyGov for the first time. She discovers she has 6 years of accumulated carry-forward concessional cap space available. Her accountant calculates that she can make a personal deductible concessional contribution before June 30 that uses a meaningful portion of that space and receive a substantial tax deduction in the process, reducing her taxable income for the year. She also confirms she falls within the income range that makes her eligible for the government co-contribution. She makes a small personal after-tax contribution before June 30. The co-contribution is automatically paid into her super by the ATO after her tax return is lodged, and she speaks to her employer's payroll team and sets up a modest salary sacrifice arrangement starting next fortnight. 3 actions, 3 separate boosts to her super balance. None of them required dramatic financial sacrifices. Each of them was available to her for years, and she simply hadn't known. By the time Sandra retires at 65, the compounding effect of these 3 strategies, applied consistently over 11 years, adds a meaningful and measurable amount to her balance. The exact figure depends on markets and contributions, but the principle is mathematically consistent. Starting earlier, with 3 tools instead of 1, produces a better outcome than starting later with just employer contributions. Here is what you should do this week. The first step is to check your available carry-forward concessional cap space in your MyGov ATO account. Look at the number. Think about your current income tax position. If you have a higher income year coming, or if you have unused cap space and room within the current cap, talk to your accountant about whether a personal deductible concessional contribution makes sense for your situation this financial year. The second step is to check your income against the current ATO government co-contribution. Eligibility criteria. The ATO website publishes these clearly, and they're updated each financial year. If you're within the eligible income range and you haven't made a personal after-tax contribution to your super this year, consider whether a contribution before June 30 would generate a co-contribution. The third step is to contact your employer's payroll department and ask one simple question. Does my employer offer salary sacrifice into superannuation? If the answer is yes, and for most employers it is, ask what the process is to set it up. It is usually a simple form. The setup typically takes 1 to 2 pay cycles, and the benefit starts immediately. There is also a fourth thing worth doing, and this one is often missed. Check that your personal contributions are actually reaching your super fund. This sounds obvious, but after-tax contributions go from your bank account to your fund, and the fund needs to receive them before 30 June for them to count in the current financial year. Processing times vary. If you're making contributions close to the end of the financial year, do it with enough time for the payment to arrive and be processed. These 3 strategies, salary sacrifice, the government co-contribution, and catch-up concessional contributions, are not new. They're not secret. They're built into the legislation that governs the Australian superannuation system. They've existed for years. What's new is the compounding urgency around using them. Every year you don't maximize your available contribution space is a year you can't recover. The carry-forward rules give you a window of 5 years on unused cap space. But that window doesn't stay open indefinitely. Once the 5-year period passes, unused cap space expires. The government co-contribution is a financial year opportunity. It doesn't roll over. Each year you're eligible and don't make a personal contribution is a year where a government payment that could have been in your fund simply doesn't happen. And salary sacrifice, the most widely applicable of the 3, is a compounding advantage. Every pay cycle where it's active is a pay cycle where your money grows more tax efficiently. Starting it later costs you the benefit of every cycle you delayed.
You now have the framework for all three. You know what they are, who they apply to, and what to do next. If today's video raised a question about your own eligibility for the co-contribution, for carry forward, for salary sacrifice, put it in the comments below. I read every one of them. And if you want a detailed breakdown of any single strategy, including exactly how the carry forward calculation works and what to do if you'd capital close to the balance threshold, let me know. And that's the next video. Your retirement deserves a compass, not guesswork.